A very good evening, participants. Welcome to another open house session on NSE Commodity Derivatives. We are very pleased to share with you that recently on 9th of October, our crude oil contract has successfully completed its first year of launch. With me to share on NSE Commodity Derivatives today, I have with me Hitesh Shethia, who is from Commodity Relationships, NSE. I have with me Sijo, who is from NSE Clearing, and with him is Sachin Shetty, who is also from NSE Clearing. So today we are going to walk you through various aspects related to NSE Commodity Derivatives. Okay, so just before going into more details, if I can request Hitesh to just share with us what are the various asset classes in commodity derivatives offered by NSE, like energy, bullion, agri, and base metal, and if you can also brief on few key contracts which market participants can track.
Okay, so at this point in time, under the Boolean segment, we have 11 futures and options contract on gold and silver with different variants. Under the energy basket, we have crude oil and natural gas as two products with futures and options along with minis. Under the base metal segment, we have copper, aluminium, lead, and nickel contracts being available along with zinc futures, minis, and option on futures contract. At this point in time, the silver options contract on goods, crude oil futures and options contract on goods, silver option on goods contract, crude oil futures, crude oil options contract on futures, natural gas futures and natural gas options contract on futures is available for market participants.
Okay, so as you were mentioning, and it is available over screen also, there are various futures and options contracts available across the asset classes. And as you rightly called out, there are some contracts which are devolving on futures as well, which are the option contracts specifically. So if you can again highlight the particular contracts of options which are devolving futures again, just for market participants.
Under the energy basket, crude oil option on futures devolves on the futures contract. So all in the money options positions, right, unless the contrary instructions are being given, devolves into futures contract. And the same goes for natural gas option on futures contract as well. For Boolean segment, we have option on futures as well as option on goods. So all variants of gold has option on futures. For silver, we have option on goods contract. Option on goods contract are those contracts which actually devolves directly into deliveries. So a deliverable settlements happens for all in the money and three immediate CTM contracts for silver.
Okay, thanks, Hitesh. If you want to elaborate more on few key contract specifications also.
Okay, so at this point in time, crude oil futures, crude oil option on futures, natural gas futures, natural gas option on futures, and silver option on goods contracts are available on NSE. Okay, the trading unit, price quote, tick size, settlements, contract cycle, and strike price interval for options contract is available on the screen. As per the standard practice in domestic exchanges, the crude oil futures and options contracts have a lot size of 100 barrels, wherein natural gas has 1,250 MMBTU contract. The silver standard contract is of 30 kilograms. The price quote for crude oil is rupee per barrel. The tick size for futures contract of crude oil is 1. That means at least a movement of 1 rupee is going to happen in the futures contract. Whereas for option on futures contract of crude oil, it is 10 paisa. The settlement for futures contract of crude oil is cash settled, whereas crude oil options contract devolves into futures. The contracts for futures and options both are monthly, and for options of crude oil contract, the strike price interval is 50. Natural gas, the standard market practice is to have 1250 MMBTU contract. The price quote, that means the price which comes on the live trading screen, is of rupee per MMBTU. The natural gas futures contract has a tick size of 10 paisa, wherein options contract has a tick size of 5 paisa. The settlement is exactly what we have, what is there for other energy derivative products, which is crude oil, and contract cycle for natural gas futures and options contract is also monthly. The strike price interval for natural gas is 5. For silver option on goods contract, which is the most unique contract, the price quote is of rupee per kg. Okay. The tick size is 50 paisa. It is delivery based settlement which happens directly on the silver option on goods contract. There are 5 contracts which are available in a year, and the strike price interval for silver is 250.
Okay, thanks, Hitesh. Do you want to touch upon briefly on the expiry as well? The expiry days?
Okay. So the crude oil options contract expires 2 days prior to the futures contract expiry date. Same goes for natural gas, wherein silver option on goods contract expires 3 days prior to the expiry date.
Okay. You just mentioned upon various asset classes which are available to trade with NSE Commodity Derivatives. So does it help market participants to have that under one roof?
Yes, there are 2 key advantages when all the assets are under one roof. Number one, collateral fungibility. The collateral being placed are basically fungible across segments under one roof when everything is under one roof. Okay. The second advantage is asset level diversification. So on one exchange, you can have an asset level diversification which can be executed along with the collateral fungibility.
Okay, so collateral fungibility is one of the key advantages that market participants will be having, right? Sijo, Sachin, you want to chip in on that particular advantage that market participant will be having with us?
So as far as collaterals are concerned, participants are very familiar with the kind of collaterals which is accepted by the CCs. But after client collateral segregation, which has got implemented, members can take the benefit of the fungibility of collateral which is there. So collaterals which are allocated to either one segment can be transferred to any segment, including commodity segment. So that's the benefit of the fungibility of collateral, and that is across all cash collaterals. Also, securities and G6 which are pledged with the CCs, all are fungible across segments.
Okay, thanks, Sijo. So, Hitesh, moving ahead, if you can just brief upon the transaction charges which are levied for NSE Commodity Derivatives segment.
Okay. So for 2 different instruments, we have 2 different transaction charges. For futures contracts, rupee 10 crore, rupee 10 per crore along with GST. For options contract, whether it is option on futures or option on goods, the transaction charges applicable is INR 100 per crore on the premium value plus GST.
Okay. So participants, we hope that you have taken due note of the transaction charges which are being levied. Now, institutional participation is also an important factor that definitely all the market participants know. So if you can guide further if FPIs are permitted to trade for NSE commodity derivatives or not.
Yes, both the categories of FPIs, that is category 1 and category 2. The FPIs which are registered with Securities and Exchange Board of India can participate in NSE Commodity Derivatives segment. For more details, you can refer to the SEBI circular dated 29th September 2022. It has the type of participants, position limits, and what kind of products which are being allowed. Just to give you a brief, FPIs can participate in cash settled products in the commodity derivative segment in India.
Okay. And does NSE commodity segment allow trading via DMA facility as well? And just for market participants, in case you don't know, DMA is a direct market access facility. So is it allowed for NSE commodity segment as well?
Yes, the FPIs which are registered can take the advantage of DMA and can take the advantage of DMA.
Great. Now moving to NCL aspects, first Sijo or Sachin, if you can brief about margining system in NSE commodities, especially for crude oil, natural gas and silver.
So the margining across all underlyings is more or less in commodity derivative segment is similar. So the basic fundamental or the margining approach that we take in derivative segment is to cover the current exposure as well as the potential exposure that is associated with a client or a member's portfolio. So when we say current exposure means margining on the settlement obligations that are due to be settled. So it could include the net buy premium payable on the client's portfolio. It could include the intraday crystallized mark-to-market losses on the futures contracts. And in case of expiry, if there is any futures final settlement to be cash settled on T+1 or T+2 day, then those become a part of our current exposure and are being levied as margins.
Okay.
In addition to that, we also try to evaluate the potential losses or the potential exposure on the client's portfolio. So we have implemented this SEBI directive on standard portfolio analysis of risk. So we compute the span margins associated with the client's portfolio to evaluate the losses associated with it. In addition to that, to cover the tail risk associated with such portfolios, we also levy an extreme loss margins. Having said that, the parameters that go into these computations, they depend upon the volatility categorization of each commodity.
Mhm.
So normally it's categorized as low, medium, and high. So as per SEBI's directive, we do a volatility back testing to arrive at the realized volatility over a period of for a certain period. And based on that, the categories are changed every 6 months into low, high, and medium. But SEBI has also said that where the volumes are very high, so we have to identify the lead exchange based on the volumes, and the CC of the lead exchange will decide the volatility category, and that becomes applicable to all CCs who are providing clearing, settlement, or risk management on those products. Basically, when we talk about span, it approaches a portfolio margining. The advantages of portfolio margining is that it takes into account the diversification of the portfolio. So highly diversified portfolio will require a lesser margin requirement. And this also takes care if a client's portfolio has contracts in a particular underlying, where there is a profit in one contract and loss in another contract, these profits and losses are offset before the margin figures are arrived at. So this ensures margins benefit to clients if they trade in futures and options of the same underlying. In addition to that, there is a calendar spread available for offsetting positions which are taken across different expiries in the same underlying. Though the calendar spread benefit has not been extended to the extreme loss margin as per the SEBI regulations. It also has a levy of short option minimum charge. It's basically to cover the losses that could be associated with the deep out of the money options. And it also has a component of net option value. It basically means we are currently doing a mark to market of the options to arrive at the current liquidation values if the premiums are to be fully paid to the members.
Okay, if you can briefly again mention what is SOMC and NOV for market participants in case they are not aware.
So, SOMC is something that when we apply span, we also see whether there are options contracts in the client's portfolio. It could so happen that these option contracts, which are currently deep out of the money, they may not have a huge span margin requirement, but there's always a risk associated that this deep out of the money options could all of a sudden, because of the volatility, become in the money. So we have to cover that margin associated with that aspect of volatility. So whenever we levy margins, so we take the maximum of span or the SOMC, whichever is higher, so that we levy margins. So we are not only covering the losses associated with the portfolio, but we are also trying to cover the volatility, which may bring some deep out of the money options into the money.
Correct.
Net option value basically is if a client's portfolio has a long option value or a long option value, then we pass on the benefit of that long option value to that. We do a mark to market, and in that case, if there is a premiums to be paid out, in such case he is going to receive a premium if he close out.
Mm-hmm.
So we do a mark to market over there. So net option value is nothing but we try to arrive at the mark to market value of the options that are included in the client's portfolio. And if it's a long option value, we pass on the benefit by reducing the span margin requirement. On the other hand, if it's a short option value that is associated with the portfolio size, so we add back the option value back to the span margins.
Understood. Thanks, Sachin, for that detailed explanation of margining system that is applied in NSE Commodity Derivatives. Now, in between, we received couple of feedbacks from member as well. One of such feedback was related to margins only. So, members say that it will be helpful if, in addition to circular issuance, NSE can give imposition or withdrawal of additional margin as other margin files. So, my question is whether we are providing as other margin files, or is it a feedback to be taken care or to be considered?
Currently, we are providing span margin files on the website whenever the risk parameters are being applied. But we are also looking into the feasibility of providing a daily margin rate file, which will provide a breakup of the margins that are applicable on a particular contract or an underlying. In addition to that, it will also cover the additional margins. And I think whenever imposed or withdrawn, this daily margin rate file will give due intimation to the members as to what the additional margin is currently applicable on a particular underlying or a contract.
Great. So if found to be feasible and implemented, that will be bringing additional help to members possibly, right?
Correct.
Great. Another member said that commodities margin utilization does not get reflected on NMAS dashboard similar to other segments. They have to go to collateral margin summary to view the utilization for commodities.
So yeah, this feedback has come from members at the various forums, and we are working on it. So when we take this up of next step of enhancement in NMAS, we will incorporate this feedback, and members can see the margin utilization in the dashboard as well.
Great. So members, as you have rightly heard, definitely the feedback is taken, and team is working upon it, and maybe soon you should be able to get the facility with you. Now, there was one concern as well, Sijo and Sachin. Members send consolidated margin statement to their clients, which includes cash, FO, currency, and commodities segment. But as they receive margin files for commodities on next day, which is due to the trading time, probably it is not possible for them to send the margin statements to their clients on the same day, as the vendor does not have the facility to send it segment wise. And members are being penalized for not sending margin statements to their clients on the same day. So is it the correct concern, or any comments you want to make on this?
First thing, I think we have to understand that the commodities market, they extend up to either 11:30 or 11:55 based on the daylight savings time.
Right.
So any end of the day margin reports, they at the best we can provide only after 12 o'clock in the night. So to have the end of the day margin reports on the same day as the trading day may not be feasible. I think members, if they do have a concern, they should take it up with the regulatory department, which is penalizing them for not sending margin statements to the clients on the same day. I think they will be best suited to address this.
Okay, great. Still, member, as Sachin rightly said, you can write to our regulatory team just mentioning your query and the challenge that you are facing. And based on that, regulatory team may respond to you accordingly. Thank you, Sachin. Now, Sijo, definitely many of the members must be knowing the processes for various activities related to, say, cutoff time to provide ABC, cash collateral, etc., final fund allocation time, everything. But still, if you can just give a summarized view over all the activities that can be done.
Yeah, so as I mentioned earlier, that participants are very familiar with the kind of collaterals which we accept, and what are the applications which we use to, and timings as well. However, to emphasize on the point that these collaterals are fungible after client collateral segregation, it is important for members to know certain timelines and how this can be used, especially towards commodities segment. So as I said, all existing forms of collaterals shall continue to for exposure in commodities segment. I want to mention GSEC as here. GSEC is maintained in two forms. One is under the CSGL account, and the other one is through depository. So under CSGL account, members who have provided GSEC under the CSGL account, they can use the collateral GSEC reallocation mechanism, which is available till 8 p.m., where they can move the GSEC from one segment to other segment. If it is in the form of depository, then these files for transfer of securities can be uploaded till 3:30 p.m. Again, this can be across segment, so members can utilize this facility as well. Excess collateral in any segment with the client will be considered while addressing or while calculating the shortfall allocation, and it will be used both in intraday as well as EOD shortfall. So members are aware about this. One more facility probably we want to emphasize here is that the cash collateral allocation, which is available till 8 p.m. for all segments generally, is extended till 11:30 for commodities segment. So members can use this facility. There are two things which members should take a note of. One is that members can make some collateral available in pool if they feel that there may be a requirement to enhance collateral in commodity segment. So if they keep the collateral in pool post 8 p.m., they can use this collateral towards allocation in commodity segment. So that is one case. The second case is that whatever collaterals are available in commodity segment, they can either reduce it or use it within the clients till 11:30 p.m. So these are few points which members can take note as far as commodity segment is concerned. Other timelines that upstream is up to 7 p.m., downstream immediate is up to 7 p.m. and end of days up to 8 p.m. is more or less familiar to all the members. One more point which I would like to emphasize is that NCL has started the facility wherein cash which is allocated to the clients can be used towards paying. So they need not either do a downstream on the next day, on the settlement day, or provide additional funds towards this. So members can use this facility. We would request you to go to the circular which is mentioned here, which is the circular dated 26 December 2023, where there is a certain conditions under which this facility can be used. Members, if can take note of this, this is a very useful facility wherein they need not provide additional funds for paying towards settlement. So these are few points as far as collaterals are concerned, which probably emphasize the fungibility mechanism which can be used for commodity sector.
Thanks, Ijo, for that crisp explanation. Members, we hope that some of the important pointers you have taken a due note, and accordingly you can make it to your use. Sijo, you mentioned just now about GSEC, which can be used which are held in SGL form, and that can be pledged with NCL. So, is it the same process of pledging just like other securities, or is there any change for GSEC to be pledged in SGL form?
So, as I said, GSEC can be held in depository or under the CSGL account. So, it depends where their members are holding it. So if the members are holding in depository form, it is the normal margin pledge repledge mechanism which was introduced. However, if it is in the form of CSGL, then the clearing member has to open an account, enter into an agreement with NCL, open a CSGL account in the clearing member's name, then transfer those GSEC from the RBI's eCuber account in favor of NSE clearing.
Okay.
And parallelly, they have to make a request in the CIM module for addition of GSEC, which can be allocated either to proprietary or to the client as the requirement may be. So this is the difference between GSEC held in depository or GSEC held in the CSGL format.
Okay, thanks. Despite you have already mentioned the timelines related to GSEC, just reiterating, if somebody wants to use pledge GSEC benefit post 3:30, that is the equity market closure, and then they want to use it for commodity, and probably again next day morning they want to use it for equity segments again. So, how it is doable, if you can just reiterate.
So, as I mentioned, GSEC under CSGL account can be reallocated to different segments. This facility is available up to 8 p.m. So members who wish that or are under the scenario where the client has already is having access in the other segment and want to use in commodity segment can transfer or reallocate the GSEC up till 8 p.m. However, as I said, excess collateral in any other segment shall be considered while assessing the intraday shortfall or EOD shortfall. So that is not a problem at all. However, if members think that they want to shift it to the commodity segment, this facility can be used till 8 p.m. And if they wish to bring it back again in the primary segment like CM or FNO, they can do this starting 7:30 in the morning. So they can reallocate this collateral back to the primary segment if they want before market.
Great. So they have enough time in next day morning itself. It is from 7:30 a.m. as you rightly mentioned, right?
Yes.
Okay, great. Thanks. There is one member who has a specific ask. This require a single EXDI file for both exercised and assigned contracts. So they are saying that currently NCL sends two files separately for exercised, which is EX01, and assigned, which is AS01 contracts.
Okay, we will look into the feasibility of the ask by the member, and then only we will be able to comment.
Okay. Still, if I mean any further details are to be provided, a member can write to NCL, right?
Yeah.
Okay. Thanks. Member, please take note of that, and accordingly you can write to NCL, and definitely they'll look into it for possible feasibility. Now, next one is probably Sijo, Hitesh, anyone can chip in. Whether auto trade confirmation facility is available with NSE for commodity derivatives or not.
Yes, the auto trade confirmation facility is available for FPI deals in commodities segment. This is the facility wherein the margin of clearing member is blocked instead of margins of trading members of FPI. So it's quite beneficial for FPIs.
Okay. Sijo, Sachin, anything else you want to say on this?
So, audit confirmation facility, which is available in the derivative segment, is also extended to commodity segment. Members who wish to enable this facility can write to NCL risk department to get this facility available, make it available for their FPI clients.
Great. Hitesh, just to continue with that, if you can briefly share upon the trends which are observed and liquidity and participation for key contracts in NSE commodity derivatives.
So the energy basket at NSE commodity segment has seen a great traction. We have seen a continuous increase in volume and the open interest. The average daily volume in crude oil options is 60,000 lots, and the highest intraday open interest in September month was 600,000 barrels. This is for crude oil. For crude oil futures, natural gas options, and silver option on goods contract, we have seen a continuous increase in participation and the liquidity as well.
Thanks, Hitesh. Now, if suppose there is a member who is having NSE commodity for their trading infrastructure, right? Now, if they want to enhance their connectivity for commodity trading, can they improve the infrastructure and what are the options?
So as far as the connectivity and the connectivity infrastructure is concerned, members can connect to NSE BKC POP, which is a dedicated POP for commodities. And because there is no co-location, so from their data center, they can connect to NSE BKC POP for further extending more facility of connectivity vendors. We have enabled Microscan and Ticona. These are two connectivity providers to connect to the NSE BKC POP for commodities.
Okay. Now, everything we discussed was for existing NSE commodity derivatives member, right? Hitesh, lastly, if you can briefly guide on processing formalities and key requirements if a member wants to go for additional segment activation of NSE commodity derivatives.
So there are basically two steps. One is additional segment registration, and the second is additional segment enablement. For additional segment registration, a trading member needs to give a deposit of just 50,000, wherein for self-clearing member and trading member and clearing member, the non-cash deposit is 50,000. NCL cash deposit is 25 lakhs, and NCL non-cash deposit is also 25 lakhs. For professional clearing member, the NCL cash deposit which is required is 25 lakhs, and NCL non-cash deposit which is required is of 25 lakhs. The additional segment registration and enablement is a quick process if you're already there with us in other segments, and the enablement documents are being available on nseindia.com on the homepage itself under
Okay, so I mean, additionally, if any member wants to get it additionally activated, please reach out to our regional team and your relationship manager, and they will thoroughly guide you on the documentary requirement, processing, as well as other requirements to be fulfilled, and it should be good to go ahead with. So thanks, Hitesh. I guess with this, what we wanted to convey on NSE commodity derivatives, we thought to have this open house session, and there was an occasion as well. As I rightly said in the very beginning itself, recently on 9th of October, we have completed 1 year of our crude oil contract launch. With this, what we wanted to share today, we are thorough. But before concluding today's session, I'd like to request Sijo, Sachin, and Hitesh if they want to give any closing summary remarks before concluding the session. We'll start with Sijo, then Sachin probably.
So, I mean, we have tried to emphasize on the fungibility part so that members can make use of the collaterals across segments. We also had a similar webinar earlier, so member can refer to the early webinars for any kind of more clarification which is required. Members can write to Clearing Corporation for any kind of clarifications from the Clearing Corporation side.
Okay, Sachin, you want to chip in with some inputs, closing inputs?
So nothing further, just that if they have any queries regarding to margins and collaterals, members do have our group email addresses. So if they seek any clarification in further to the webinars that we have and the discussion that we have today, we are more than happy to help. They can reach us on our group email addresses.
Sure. If you can just reiterate the email ID for betterment of market participants.
So we have a common email ID which is support@nsesystem.co.in. Then we have group email IDs like risk_ops@nsesystem.co.in, collaterals_ops@nsesystem.co.in, and our toll-free numbers are also available.
Thank you, Sijo. Hitesh, any closing remarks from your side?
So the members which are still in the equity segment can further diversify themselves in the commodities segment. FPIs, category 1, category 2, both are enabled with us. Auto trade confirmation facility for FPIs is being enabled. Products which are allowed by the regulatory body are being available as far as the liquidity and participation is concerned, that is crude oil and natural gas, futures and options contract both. And the most safe, resilient technology platform we have, the connectivity, the BKC POP is being available. And we have seen a continuous increase in the trend. There are absolute economical transaction charges being applicable in the commodity segment at this point.
Thank you. So thanks, Hitesh, Sijo, and Sachin for sharing the key insights with all our members and other participants from members' side. And on behalf of everyone, I take this opportunity to thank all the participants who have joined today's webinar. As you all of know, that we'll keep doing more and more open house webinars on other topics as well. Very soon, we'll be coming up with other couple of topics which are requirement by you as market participants. So keep attending our sessions and keep giving us feedback on more topics where we need to do sessions to connect with you. Thank you very much again. Have a great day ahead.